Dr. Shubhada Rao is the President and Chief Economist at Yes Bank. She is responsible for the economic knowledge banking, providing macroeconomic research outlook at the bank. She is a member of Yes Bank's Assets and Liabilities Committee. Shubhada brings with her over 20 years of experience in academia and industry, wherein she has pioneered research design geared to facilitate business decisions. Prior to joining Yes Bank, Shubhada has worked with Kotak Institutional Equities as Chief Economist, with Bank of Baroda as Economist with Risk Management, and as Head Economic Advisory at CRISIL Advisory Services. She also served as Chief Economist with Times Bank. She began her career in banking with ICICI Bank in their Planning and Treasury Department after completing a PhD in economics from the University of Mumbai. Shubhada is an active member of the Economics Committee of Industry Associations and is currently Chairman of Economics Committee of Bombay Chamber of Commerce and Industry. As a thought leader, she has made extensive presentations on Indian economy to state dignitaries and many OECD economies, consulates among others. Her views are often sought on domestic and international electronic and print media like CNBC, NDTV Profit, BBC World, Bloomberg, and business dailies like Economic Times, Business Standard, Mint, Hindu, Business Line, Outlook, Business Today, Business Week, among others. May I now request Dr. Shubhada Rao to please address the gathering.
A very warm good afternoon to all the fellow Indoreans. Indore is my hometown, my birthplace, so it's coming back home for me. And I'm very, very proud and privileged to be part of this event. And thank you for sending in the kind invitation. Abhishek, there is a bit of an occupational hazard here. Economists love to talk. So you will have to first tell me how many minutes do I have that I can share my thoughts with this fantastic audience. About a half an hour to 40 minutes? All right. Okay, that includes a Q&A? I need to be specific. All right. Thank you. I just wanted to save you guys from trouble because economists can go on for hours and hours together just looking in the crystal gaze, you know, and give forecasts and outlook, and you will say, hey, what are you doing? Give us some concrete solutions. So to save all of you from that, you know, long playing record, I thought let me just quickly specify my time and then try and share our thoughts on what's going on across the world, how does it impact India? More importantly, how does it impact the businesses and all of you, the future business leaders, in shaping and evolving strategies? How does one cope with trouble? My preceding speakers, both extremely erudite, flamboyant, stylish, were leaders. And they gave out their thinking on how does one lead when you are in a turbulent times. Being an economist, I'm going to change that thought process. I'm going to share with you how to understand the turbulent times, what are the lessons that we need to learn from those turbulent times, and how best not to repeat those mistakes, and build strategies around safeguarding our economic well-being. So quite clearly, an economist's role is clearly etched out on finding out what are the key drivers that drove this turbulence that we are currently in. Quite clearly, I think, you know, the watershed would be perhaps the historians of future may write the economic history of global economy pre-Lehman and post-Lehman, because it's around the 2008 mid-September time that the world came to shattering reality, that all that we understood, that the party of economic growth is never ending, came to a rude shock that indeed there were breaks to this party. What happened? What happened around that time? There were very few and very important pertinent lessons, that of excesses. It was a period of excesses. First, the excesses of the financial sector, and second, followed by it, excesses of the government sector. And that actually culminated in what is going on currently, as we all know, is Eurozone crisis. I'm going to share what we make of it. Quite clearly, Lehman was more, Lehman kind of an event, or Lehman moment was a manifestation of policies, as I said, of excesses, and perhaps too much of faith in market economics. When I say excesses, what happened? It was Indian or a US household continuously consuming on the basis of his or her borrowing capability. So there was a leveraged consumption. There was a leveraged consumption because interest rates were kept far too low for far too long. So there was no concept of risk amongst the households, amongst the borrowers. They always believe that interest rates are going to remain very low, and let me continue borrowing even to consume, because I know that interest rates are not likely to rise. And that's what I meant when I said that party was not going to end. They continue to invest in houses, in built houses and properties, in real estate, thinking that continuous rise in house prices will help them build their wealth. And of course, with this notional wealth effect and this leveraged consumption, what happened? Crude oil prices started rising just around 2006, 2007. Interest rates were forced to be raised by the Fed. And then that is the time the pinch started. The leveraged consumption began to get hurt badly. People who were not capable of borrowing were actually given money, and they could not repay their interest. They could not forget the principal. They could not even repay their interests. That started the bubble. The housing prices began to collapse because of oversupplies. So quite clearly, it was a problem of excesses. Combining that, you had, creation of exotic products. The bank, which actually created a risk by giving a loan, continued to create exotic features around that loan and sold that risk to some other financial entity, which in turn created further exotic features to that product and sold it to other entity. So there was no ownership of risk. So this ultra exotic created derivative products, as we call them, continued for many more levels until a time that you did not know that when the underlying borrower defaulted, who actually paid? So that was the confusion. And third, the most important lesson was ultimate and perhaps a misplaced faith by the regulators, by the supervisors on free market economics. Too big to fail was the mantra used by them. But obviously, this was not to be. A big size holding like a Lehman collapsed. And what happened? All the myths came shattering that nothing is too big to fail. You needed to clearly improvise on your regulatory and supervisory framework. You needed to tighten the kind of a framework of risk management. And that is what was the first lesson that we need to learn. Okay? Following the excesses of the financial sector and the turbulence thereafter, in a globalized world, what did we see? We saw the Eurozone crisis suddenly erupt and emerge in a big way. What was this Eurozone crisis all about? Or I should not even use the past tense because it's still ongoing. What is this Eurozone crisis all about? It's the crisis essentially emanating from the government's excessive borrowing programs without putting in place strong sources of their own funding, okay? They were depending far too much on the market borrowings, and therefore once the confidence eroded once the risk erupted for a country like Greece, where the excess leveraging or excess borrowing actually resulted in investors, the bondholders as we call them, demanding far too much of yield or interest rate on a supposed risk-free government borrowing. That is the time the world took notice, and sat up and took notice that even governments can't be perceived or no longer can be called risk-free. Why was it? Because of excessive spending by the governments without putting in place on their revenue side strong, sustainable revenue model. So what did happen? Country after country continued to borrow more and more from the markets, and markets had, up to a point, had enough faith. But once they realized that this country is about to default on a repayment of a loan, that's the time the investors' faith was shattered, investor confidence was shattered, and the so-called risk-free government bonds, or the issue of government paper, say a 10-year or a 3-year maturity paper, which typically used to have an interest or an yield of 1 or 2%, actually shot up to about 20 to 30%, clearly saying that no more of risk can be handled by the investors, even if that risk is being given by the government. So quite clearly, what are the 3 lessons that we learn from the global crisis, starting off with Lehman and then the ongoing crisis from the Eurozone? Very clearly that you cannot continue to go on leveraging in an excessive form. You need to just about have a more mature mix of borrowing, of leveraging as it is technically called. Second, that you need to have very strong risk management practices. You cannot allow the financial entities or the stakeholders in the economy to govern on their own principles of market economics, because there's no such thing as too big to fail. The third and more important lesson on hindsight that we learn is that we need to save in good times to provide adequate buffers to be able to. I have the choice to choose. I have the choice to, make a decision of what detergent I want, what soap I want. And that, I think, the freedom of choice backed by, enough earning power, enough spending power, actually has led to consumer boom. So I don't think I can use them mutually exclusively. So if you are a thriving, growing economy, you can consume as well as save. Both the levels are only going to continue to rise.
According to economists, how much time is required for recovering out of this current recession period?
If I were able to predict this, I would be collecting my next year's Nobel Prize. But on a serious note, there are far too many uncertainties in the global marketplace. When I say global marketplace, at least US is showing some signs of recovery in terms of be it employment or in terms of some risk appetite in businesses returning. So while US will continue to grow in a very anemic fashion, but the fact is it will grow. You can't say the same thing about the Eurozone. What's happening is the problem which actually started with the peripheral economies of Europe, that we call them today, the PIIGS, Portugal, Ireland, Greece, Spain, and so on, has now begun to also transmit some of the pressure to the core Euro economies. What do I mean by core Euro economies? Economies like, Italy, France, and Germany. How do I measure that stress in core economies? German bond auction. When I say bond auction, the German government in borrowing program issued bonds and wanted the markets to buy those bonds. Now that bond auction did not get fully subscribed. That means there is some tentative nervousness also regarding the core economies or hitherto strong economies like Germany. For other case, like France, what's happening? France or French government's borrowing costs are moving up. Nowhere had we heard of bond yield for these core economies, bond papers, going up to 4 or 5%. In recent times, they actually came close to 7%. And to me, that is something that is difficult to kind of gauge in terms of the length of the problem. Why is there a problem in gauging or putting a time to it? As I was earlier mentioning, at Lehman moment, it was only the financial crisis, and it was quickly at least getting not resolved, maybe addressed. This time round, it is not just economics problem. It is a problem of economics and politics, because it involves government budgets, because it involves cutting on government spending. Cutting of government spending means lower welfare for the broad population. So all this fiscal discipline will prompt these governments under stress in Eurozone to cut down on their expenditure, to lay off people, or to postpone the retirement age. What does it do? It brings in serious, stiff opposition from people. People may vote out those governments who are announcing austerity measures. And that is the reason, because it is a combination of economics and politics, I think the problem will be much more long-playing one than, giving it a window that, okay, next 3 months or next 6 months, we could see a resolution coming. Because here also, it is not a probable risk, but it also has a risk of perhaps some of the current members of Eurozone breaking out or slipping out. And that is something which would be pretty much devastating for the global markets. So nobody wants that terrible, terrible thing to happen in actual way. But quite clearly, the uncertainties are huge. It's going to be a bit messy, bit long playing. So I think what we in India need to do is sit tight in these turbulent times, play the game prudently, build your risk management practices. Do not go all over the place in making very pompous business plans, but grow prudently. I think the lesson that we need to learn is we need to grow, but the quality of growth becomes of extreme importance in these turbulent times, because any catastrophe in the financial markets, what is happening to currency is not because of complete domestic doing of ours. It is also a large part is being played by what's happening elsewhere. So we need to be very cautious. We need to grow in a very cautious and prudent manner.
Thank you. We'll take the last questions as we are short of time. What rate of growth will help India reduce poverty to insignificant levels, and how?
I think, everyone has been talking of, we are doing very well. Compared to what the globe is doing, we are still growing at close to 7%. I think there is a bit of a caveat there. We are surviving on a 7% growth, or we're just about hanging in there, as they call it, with 7% growth. For India to allow and facilitate the advantages of high growth to percolate down to the lowest strata of the people, or as Professor Prahlad called, bottom of the pyramid, we need to grow on a sustainable basis at over 9% or so, not just for 2 years or 4 years the way we saw it, but we need to grow secularly in that fashion, so that maybe after 10 to 15 years, we could see poverty levels coming to acceptable levels of poverty. What Dr. Tharoor also earlier alluded to, I listened to whatever he said very carefully, okay? So what he alluded to earlier was that we need to grow. The Gini coefficient in economics measures the inequalities. And unfortunately for India, the inequality, the Gini coefficient has actually risen in recent times of prosperity. So what we need to do is, we definitely have rich getting richer, but they're getting richer much faster. We need to add the same speed for the poor to get better off in a similar speed, in a similar fashion. It's only then the inequality coefficient, or we call it Gini coefficient, will get lower. So quite clearly, speed is also of importance, but more important, sustainability. We can't have a growth of, 9% for 3 years and then grow at 5.5 to 6% for next 2-3 years. We need a sustainable growth. And once again, I come back to it, it needs policy facilitation. And we need to keep ourselves reminding that we need policies to be able to grow at 9% on a sustainable basis for years to come. We have demography to support that growth.
Thank you very much. That was a very enlightening session. Before we close this session, there is a small award ceremony. Under the able leadership of Mr. Amit Bidasaria, Honorary Secretary of Indore Management Association, last year IMA started an endeavor to have its own graphic and animation team. This year, we came up with a program called the Animation Mastero on competition format, where we had 25 teams of 3 members each, participating from various animation institutes. The winners of the competition were given retainership contract to make the animation and graphics under the guidance of IMA Secretariat. May I request Dr. Shubhada Rao to kindly give away the trophies to the winning teams. The first prize for the Animation Master winner goes to Arena Animation Geeta Bhavan, the team comprising of Deepak Rai, Mahesh Ingla, and Mohan Prajapat. The prize for the Animation Master runner-up team goes to Framebox, the team comprising of Sanjay Jaiswal, Mitisha Soni, and Shobha Mehta. The prize for the Special Mentions Team 1 goes to team comprising of Chandni Rochlani and Sudesh from Arena Animation Geeta Bhavan. The prize for the Special Mentions Team 2 goes to team from MAC Academy comprising of Akshat Bhatnagar, Hemant, and Rajesh. Thank you, ma'am. I would now request Mr. Abhishek Javeri to come up and present the memento on behalf of Indore Management Association to Dr. Shubhada Rao. Can I request Amit Bidasaria to please come and do the needful? May I now request Mr. Arun Bevla, the President of Aisha, to please come and present the memento to Mr. Abhishek. On behalf of Team IMA, I thank both our eminent speakers of the session for sparing their valuable time to be with us and sharing their thoughts and insights with this audience. I now announce this first business session closed. Thank you, everybody. Now we break for lunch.